Hello everyone. In this video, there will be a recent examination of the financial instruments available for entrepreneurs. To do so, the lecture will be divided as follows. The, we will first have a brief explanation of the traditional financial system, then a focus on the differences between the two major sources of financing for any given venture, which are debt on the one hand and equity on the other hand. We will then review the most relevant sources of equity financing for entrepreneurs. And finally, we will show the relationship between valuation and capitalization tables before and after raising the equity of a company. I hope you will enjoy this lecture. So, there are generally two ways for lenders, here in the sense of investors, and borrowers, here in the sense of entrepreneurs, to interact. Investors have two ways to spend their savings. They can either deposit their savings to the bank, which will transform these deposits into credits to lend capital to the borrowers. The alternative is to buy securities that has been issued by the borrowers through financial markets. These securities will take the form of either bonds, if they want to finance their investment by raising new debt, or of stocks if they want to raise new equity. However, these traditional patterns are more relevant for already well established companies than for entrepreneurs starting a new or innovative business. Why? Because either banks or the financial markets will require any kind of tracking records or data demonstrating the solvency of your business. Then, for early stage startups, it is usually hard to get these types of financing. Nonetheless, it is important to bear in mind the difference between the two major sources of financing for any given venture, that is, debt or equity. If an entrepreneur goes to the bank, or same as if an established company issue bonds, it consists in borrowing a certain amount of capital that should be repaid with fixed interest rates payments at a regular frequency for a given period. If the business goes down, in this case, the creditor, for example, the bank, has the right to liquidate some or all of your assets to get his money back. This, in addition to the fact that payments are constant and known in advance, make this kind of investment not very risky. Consequently, the return on such investments is relatively low. On the other hand, raising capital by issuing new equities is equivalent to sell a share of your business in exchange for a certain amount of capital. The new shareholders would then have some control over your business in addition to a share of the benefits in the form of dividends. Since profits may vary a lot across time, dividend payments are variable by nature. Moreover, in this case, if the business goes under, shareholders just lose their money. These features makes equity investments much riskier than debt investments. It then requires a higher rate of return. So, as I said earlier, traditionally, a company can either go to the bank or to the financial markets in order to raise debt or equity. But entrepreneurs will face difficulties to do so because they are not well established enough to use one of these two solutions. Then we can list alternative sources of equity financing. The first one would be that in some what is sometimes referred as love money. You go to your friends or family and relatives to borrow some capital as to start your new business. It quickly reach limits in terms of amounts. Plus, one doesn't always want to mix business with friends or family. Then another alternative would be crowdfunding. Crowdfunding would be the use of small amounts of capital provided by the large amounts of individuals. The total amount raised is rather low, and the return on investments varies a lot across crowdfunding platforms. It can even be zero in the case of donations. It has the advantage to give visibility to your venture and maybe attract some other investors, such as business angels. These business angels, are individuals investing their own money in startups. The amount of money they invest varies from a few thousands to a few hundred thousand euros, and they usually ask a very, very high return on investments, something probably around 30% a year. So while business angels are individuals, venture capitalists are often regrouping many investors. The amount of invested capital is often larger than for business angels, and they usually can offer not only capital but also technical and managerial expertise. When the company is well established and successful enough, it is then possible to consider an initial public offering, which means going public to the financial markets. A company going public means that it gets listed on the stock exchange and can directly raise new equity on the markets. So this is for well established firms again. Okay, so finally, it is important to keep in mind the relationship between valuation of a business, equity increase, and the dilution of old shareholders. Let's take the example of a business valued at 200,000 euros. The company's equity capital would be here divided in 100 shares that are split 50-50 between the two founders. If the company needs an investment of 50,000 euros, given the valuation of 200,000 euros, each share worth 2,000 euros. Founders will then have to issue 25 new shares to raise the 50,000 euros necessary to their investments. What is the impact on the control of the company if one single investor buys the 25 new shares? Well, before the capital increase, each founder has 50 shares out of 100. So they both own 50% of the company. After the capital increase of 50,000 euros, the two founders keep their 50 shares and the new investors get 25 shares, the 25 additional shares uh, relative to the new investments. So there are now 125 shares in total. The founders have now 50 out of 125 shares, so they each own 40% of the company now. 50 divided by 125 equals to zero point 0.4, which is 40%. The remaining 20% are now the property of the incoming investor. This illustrates the dilution of the ownership following a raise in the equity of a company. Entrepreneurs have to keep well in mind this mechanism before considering financing a new investment through equity. Thank you very much.